This is the White Coat Investor Podcast, where we help those who wear the white coat get a fair shake on Wall Street. We've been helping doctors and other high-income professionals stop doing dumb things with their money since 2011.
This is White Coat Investor Podcast number 342, Captive Insurance. When you're exploring career choices, consider locum tenens. Locums gives you flexibility with short-term assignments, but there are many more benefits that it can improve your quality of life. The best way to research the vast world of locums is to talk to an expert. CompHealth created the locums industry. Work with them to identify what you want out of your life, and work and find the perfect fit. Locums works best when it's all about you, and that's their focus. They specialize in everything you. Learn more at comphealth.com or visit them in person, WCI Con 24, February 5th through 8th in Orlando, Florida. Our quote of the day today comes from John Templeton, who said the four most dangerous words in investing are, "This time it's different." All right, welcome back to the podcast. A lot of you are out there checking out potential contracts for next year. You're getting your first job, or you're getting a second job, or maybe you're up for partnership. If you need some help reviewing the contract, we have a recommended list for that. whitecoatinvestor.com/contract-negotiation-and-review is where you will find that. You can go to whitecoatinvestor.com, look at the recommended tab. You can just go to whitecoatinvestor.com/recommended and click on contract review. We got a bunch of people there that can help you with that. They can get you the information from MGMA, et cetera, so you know you're being offered fair compensation. They can help you understand everything in the contract, make suggestions to improve it. Most of them will even negotiate on your behalf if you want. But check out that list if you're in that situation. You don't want to end up signing a bad contract with some terrible non-compete clause where you're getting paid 75% of what you're worth. Get it reviewed. It's worth a few $100s. All right. By the way, thanks for what you do. Right? That's why they put these contracts together, is because what you're doing is important. It's valuable. And that's why, you get paid so much. That's why you're listening to this podcast, because you went through all that training. So thanks for doing that. I know every time myself or one of my family members goes to the doctor or is in the hospital or whatever, my dad's in rehab as we're recording this. I know I sure am appreciative of all the sacrifices you all have made. By the way, my wife this morning signed me up for my first colonoscopy, so wish me luck with that. But I've got that to look forward to. Somebody emailed me the other day and said, "You got to get a colonoscopy. They found a polyp on mine when I was 40. And so I don't know what I said on the podcast a few months ago, but I'm getting a colonoscopy now. So I'll let you know how it goes. If nothing else, as near as I can tell from listening to a lot of stand-up comedy, it'll provide some funny moments. Anyway. Today, we've got a guest here. This is not somebody I have a financial relationship with. It turns out he's a pretty loquacious dude. So he said, when I got to the end, I'm like, "You're pretty loquacious." And he's like, "What's that mean?" And I told him, and he said, "Oh, you mean long-winded?" And I'm like, "Yeah, you're a little long-winded." So this podcast interview goes a little while. And he goes off into a few tangents from time to time on the answers to my questions. But I think it's a really interesting subject. And I think there's a lot of doctors out there that have heard of captive insurance, but don't know what it is or how it works or why it might be beneficial to them. And I think we got into that in this podcast. And I think it's interesting. I think a lot of you will find it interesting. If you don't, well, shoot, I guess you know where the fast forward button is. But I think it was pretty interesting. I think you'll enjoy learning about captive insurance as well. There's some real tax advantages there, but you got to make sure it's a legitimate insurance company at the end. There's a fellow by the name of Hale Stewart who said, "Captives sold as a tax mitigation tool and not as a bona fide risk reduction are not really captives at all, but I keep running into them." And I think it's something you got to watch out for sure. And we talk about that in the podcast as well. Let's get into it. Our guest today on the White Coat Investor Podcast is Van Carlson, the founder and CEO of SRA 831B Admin. Van, welcome to the White Coat Investor Podcast.
Yeah, thanks for letting me get on your show, Jim. I appreciate it.
Well, this is the first time we've had you on the show, so presumably nobody listening to this actually knows who you are. Why don't you tell us just a little bit about yourself? Tell us about your upbringing and what it taught you about money to start with.
Grew up as a farm kid. And one of the things that's unique in my life was I was selling at a very young age. One of the things that my parents did on the weekends would go to farmers markets in California. So whatever we didn't sell during the week to the local grocery stores, we would go out to the farmers markets. And I was 6, 7, 8 years old and I was working with my parents and selling fruit, watermelons, cantaloupes, everything else we were growing around the farm at Salinas, Santa Rosa, Walnut Creek, and those places. And so I got exposed really quick, just dealing with the public in general. And I had a great time and a great childhood. Learned to work hard. I remember growing up, I wish I could be my dog because he always didn't seem to work very much. And I can remember as a kid wanting to be a dog. We worked hard, and that's part of farming. And it helped with my work ethic and perseverance and all those things you need to have today in order to be successful in anything. And so I was very lucky, very fortunate to grow up that way. And, I was making change at a very young age. That's when everybody still had cash in their pockets, right? They'd come to the farmers markets and so for me, it was, I don't know, it's been my upbringing and I've always been enamored with owning my own business. I own 3 or 4 operating companies today. I've always kind of, even though I'm in an exciting industry called risk management, I consider myself an entrepreneur still. And really that's what drives me. I mean, I always love seeing good, successful business models. And that's one of the things I think that kind of gravitated me towards this industry. I mean, I never set out to be a risk manager. But I did start my own property casualty agency. I was pretty successful leading up to '08. That's when I saw the Great Recession come in. And unfortunately, I saw a lot of business owners that were clients and friends of mine go out of business because they just leveraged themselves to the point where every year was going to be better in the previous year. And I thought there had to be a smarter, better way to run a business. And that's when I got really exposed to what I do today. And that's really managing clients' risks that they can't transfer through traditional channels. I try to, it's obviously insurance, risk management, all those things, from an entrepreneur standpoint, that just sounds a little boring. But to be honest with you, it's an exciting business to be in. So.
Very cool. It's interesting. You mentioned wanting to be a dog. I have a daughter who thought she was a dog until she was 5 or 6. I think the classic moment was when she literally crawled off a plane once barking. But it was a good time raising a dog and very fun. All right. Our subject for today is captive insurance, sometimes called an 831B plan. Let's start with you just explaining what captive insurance is.
Yeah. So, captive insurance is really self-insuring risk, right? And really the people that are doing this, right, have been doing it the longest are your Fortune 500 companies, your large companies, any brand recognized company you can think of out there that develops, manufactures, or sells a product is really self-insuring their own risk. And what I mean by that is your traditional carriers will not, for a great example is Microsoft. Nobody's going to sell them a product liability, right? So they got to self-insure that. And one of the ways they do that is forming a captive. So these are things that they're still, like traditional businesses. You have work comp, general liability, property coverage, business personal property, commercial auto, all those are premiums. You transfer that risk to an insurance carrier for a dollar amount known as premium, and you transfer that risk to those carriers to take care of any physical loss damages, lawsuits, any of those types of things. The big companies can't do that, but they still act that way. So a lot of these companies have their own insurance companies, and they're known as captives. One of the things that we've done, and kind of leading up to my conversation earlier about getting into the Great Recession and really trying to bring this concept down to the small to middle market business owners of self-insuring risk. And they do a lot of it. I would say they have more exposure to risk than big, large companies do. And that's where our price points come in. And that's really where the 831B starts to play out. So think of an 831B as very similar to a 401k. You're able to expense it at the operating company level. And as long as they qualify an 831B, the money you put into it stays tax deferred. And that's the advantages. And it's very similar to a 401k, right? I'm going to expense it as an operating company level, drop it into this bucket, and it's designed for my retirement, my employees' retirement. And it stays tax deferred up until a certain point in time when I use it for my retirement, or I'm at an age where I have to take it out, right? So again,
that's presuming the money doesn't get used to pay for the risk, right? I mean, it sits there for a while covering your risk.
Absolutely, absolutely, and that's really, that's what the whole purpose is to, as those things stay deferred, you're in a, as they grow, either through premium, surplus, and investments, you're in a much better position to handle risk more effectively. And that's why the code exists. It came in existence in 1986. So a lot of clients, so you can own a captive and not be an 831B. One of the things that we specialize in is 831B. So we're an 831B admin company. No different than a 401k admin company. We make sure that you follow the test, that you can stay elected, that those dollars can stay deferred. There's a lot of rules and regulations into this program, no different than a 401k. And we, as the administrator of your plans, make sure you stay in good graces with the IRS, and we can still keep these funds deductible and deferred.
Hey,
And
explain how you could have captive insurance that's not an 831B.
Yeah, so a good example would be the Microsoft guys, right? They don't care about the most you can put into this thing in any 1 year, and it does change to year depending on the CPI. But when it first came out in 1986, the most you can put into this plan was 1.2 million a year. Now it's at 2.65, and it's probably going to increase for next year just because inflation's up, because now it's tied to a CPI. Those dollars stay deferred. Well, if you're Microsoft, you need to put 10, 20, 30 million dollars away for your insurance risk that you have on your books. So you can't really take advantage of the 831B because you're going to pierce through that dollar amount. Now, and there's some strategies there that we work with business owners all around the country doing some things differently there, but that's where you don't care about the tax deferment. You just have this risk. You got to put a lot of money away. You're expensing it from your operating company, and now you're dumping into this. And by the way, this box is a C corp. So this 831B plan is a C corp. So you're going to pay corporate taxes and all that stuff on all those premiums. If you elect under an 831B and you stay under the $2.6 million premium thresholds, you can keep those dollars deferred. So meaning that it still comes in as a tax, it comes as an income, but it's not taxable income inside the C corp. Again, I don't want this to sound like a rocket ship, but it is designed, and really it's really designed for the small to middle market business owners, which is the clients we want to help. I mean, if you go back to 1986, what's going on in the marketplace today is very similar to what was going back in 1986. You had the hardening of the market. You had a substantial increase in exclusions going on in the marketplace. If you used your insurance, you got canceled. All those types of things were going on. And one of the industries that were really being hit by it was farmers. Crop insurance was in the private sector at the time and became so unprofitable. Private sector's for profit. No different than they want to do flood insurance, no different when they, earthquake prone areas and all those types of things. They get out of that business. And today, obviously it's backed by the federal government. If you looked at crop subsidies today, the largest crop subsidies farmers receive today is really the subsidy they get off of the premiums for crop insurance. That's a huge farm subsidy today for farmers, because if they had to truly pay the premium cost to buy crop insurance, it wouldn't be affordable. They wouldn't buy it. It'd just be too darn expensive. And some of them, unfortunately, still choose not to buy them because it's so expensive. But back then, they were totally self-insuring all that themselves. They had nowhere to go. And so that's why Congress got together and said, hey, we'll create an incentive for these guys. If they're going to have to self-insure risk, we got to create an incentive. And we want them to be able to take on more risk more effectively and efficiently through tax-deferred dollars. That's why the 831B came into existence. Now, you fast forward 40 years, almost 40 years, cyber wasn't even on the realm, right? I mean, cyber wasn't even thought about back in 1986. And now it's one of the biggest things we have to worry about today. Brand reputation in the community. I mean, we're all going digital marketing. We're all going social medias. We're all doing those things. It takes years to build up a reputable brand in your industry, your company, your community, but it can take seconds to destroy it. You talk about supply chain risk. I mean, we weren't even talking about global economies back then. Now we're absolutely a global economy. And then unfortunately, you add in COVID-19 on top of all that. And one of the things that has helped us, one of the things that gets exciting at cocktail parties is like, man, what do you do? Well, I'm a risk manager. I used to tell people I just sold life insurance and they would just stop asking me what I do. And that was, but today unfortunately, it's a real simple conversation for us. We tell business owners all the time. It's like, every business should have their own PPP plan, but it needs to be self-funded. Because we don't know if a COVID-19 is going to happen, but I can tell you this, the complexities of our running a business today relative to employee relationships, cyber, the data we're trying to collect in order to market back to our clients. We have a responsibility that we didn't have responsibility. And now we're relying on a bunch of third-party people, meaning that I don't have paper files anymore. I put all my stuff up in the cloud. I don't have control over that cloud, but I hope I have access every day to be able to operate my business. We call that third-party business interruption today, which is, you're dependent on a lot of different industries now to just do your day-to-day business. That wasn't there 40 years ago. And so, when you look at the risk complexities of business, it's gotten much more complicated, substantially more complicated than it was 40 years ago. 40 years ago, it was just, hey, crop insurance, we can't buy it. We need to, how are we going to be able to put more money away for our own, if we're going to have to self-insure? And so that's what drove this code. And then when you look at the PATH Act, back in 2017, they made some changes. One of the big changes was that they increased it by $1 million and they added a CPI rider. As inflation goes up, the ability to put more money into these things goes up as well. And since 2017, now it's 2.65. So, and we haven't got our numbers yet for 24, but our assumption is that number is going to go up as well. But now that's the ceiling. There's a lot of rules in the middle of all that that you have to comply with. And that's, as your admin, we're the ones that make sure those rules are applied.
Okay, so let's apply this to my audience. My audience is mostly doctors. So let's say there's a partnership of 5 obstetricians, and they're paying $100,000 a year right now for malpractice insurance. And they decide they want to form a captive. So instead of sending that $500,000 a year to another insurance company, they form a captive insurance company. They put their $500,000 into an 831B plan and start investing it. They don't have a claim that year. They put another $500,000 in the next year. They now got $1 million in there. And now they have a claim and end up having to pay out. What happens if, they got a $2 million claim and there's only $1 million in this plan?
No different than what insurance carriers. I mean, once you meet the limit of the contract, they're gone. And so most of these guys are carrying $1 million. They may carry an excess. If there's higher limits, and it really depends. I mean, there's a lot of nuances to your scenario, but it really depends on how we're crafting. And the nice thing about owning a captive is we can structure it whatever way we need to, however the policies need to perform. Remember, I was telling these are C corps. Well, one of the things we can do is, if you need a $2 million policy, and if you need paper, and what I mean by that is, depending on where you're licensing at, what state you're in, that you either have to carry malpractice insurance or you don't. Sometimes contractually you may have to, because you're doing business with an insurance company and they want you to carry malpractice or something like that. All those things, we get into those things. But if you don't have to carry paper. I literally had this conversation this morning with a group of doctors, and they found out their insurance was going to cover them on something. One of the things that's happening right now in professional insurance is the price points have gotten so high, cost-wise, that the insurance carriers know that your pain point can only be so much. You're only going to be willing to pay so much. Well, one way if they know your price point's at a limit, one way to offset their risk, if they can't charge more premium, is put in more exclusions. And that's exactly what we're seeing today. We're seeing a lot more exclusions come into play. And that's across the board, from directors and officers to professional liability insurance. If you have a niche type medical practice, you have so many exclusions today in your medical practice. It's crazy. I thought I was a little surprised this morning in the conversations I was having, because normally you have a clause in there that says right to defend, meaning that the insurance carrier has to at least defend you. This carrier got off the right to defend, which was a little surprising to me, because that's one of the things you would at least want to backstop on for malpractice is your carrier's at least going to pay for the attorney to defend you. Now, if it turns out you did something you weren't supposed to, or there's something punitive or something like that, they'll have exclusions on those where they're not going to cover you for those things. But normally, at least the attorney bill's covered. And in this scenario, it wasn't, which I was kind of surprised to hear that. And I think those things are just going to continue to play out, unfortunately. So in those scenarios, if the limit's exceeded, it's back on the doctors, unfortunately. It's just, there is no, I always talk about when I was selling traditional insurance, was I still do with one of my divisions of my company. If you're grossly negligent, it doesn't matter how much insurance you have. It's going to blow through the limit. And, today juries are, awarding unbelievable type lawsuits and punitive damages to where no insurance carrier is going to have enough insurance for you. And that's just it happens. It doesn't happen as often as we think. Obviously, I do think it gets glamorized when it does. The media is going to pick up on all those things. But, a lot of lawsuits are settled for far less than what we probably know on average. I think the average lawsuit's around $200,000 in medical. But the reality, though, is, for me, I look at that and say, well, no, there's other extenuating circumstances with malpractice. I had a spa med where it was, plastic surgery going on. And this gentleman said to me, he said, hey, I love your program. I'm able to defer some profits out of my company. I'm able to put it into this vehicle. I'm never going to use your insurance. Within a year, he called me up, said, hey, I got a problem. And unfortunately, in spa med and plastic surgery, I didn't know this, but people call around to get pricing on liposuction. And he had made the local news because there was a wrongful death, and he was being sued for it. His malpractice carrier just became a math problem for him. When you look at your practice, and like I was saying earlier about your community and your reputation in the community and all those things, insurance carriers don't take that into consideration. They're just doing math. Hey, how much is it going to cost to defend? What's the likelihood to lose? If we're going to lose, can we settle now? And how much can we settle for versus trying to hand this over to a jury? And knowing the details of this case, I thought the doctor was very much in his, he didn't seem like he acted improperly. However, the insurance carrier still settled. And now, and it affected his business drastically. So much so that we had to hire white hats to go out, and because they Google the articles that are written about you come up first because everybody reads them, and the way the algorithms work, that's the first thing to pop up on the screen. So now you got to write op-eds, you got to write different articles, you got to start pushing that stuff down. So when people search you, that's not the first thing they're going to read about you. That was the problem. And he was just thankful he had done our program. But when you first talked to him, he never looked at this being an issue it's never come up. And now how we're dealing
program, you're talking about some sort of reputation management insurance.
Absolutely.
Cyber protection insurance, that sort of thing.
Yeah. So when our specialty, truthfully, is not taking over traditional insurances, we think traditional insurances do a great job. What we need to look at is exclusions, and we also need to look at risks that you're retaining. And what I mean by that is you can't transfer the risk. For example, this group of doctors you're talking about, they transferred that risk by a malpractice insurance policy, typically for $1 million. They might get a $5 million policy. It really depends on what they're doing. Most hospitals today are all in their own captives with their malpractice. It's the only way they can afford to do it. But, if you got a surgical center or you got a family practice or, you got you name it in the medical community, you may carry your own policies, but typically it's going to be at about $1 million limit. And so if you're paying $40,000, $50,000, $100,000 for that, you got to decide, for pennies on the dollar, I'm just going to keep paying that premium. What you're not getting though is supply chain risk, brand protection, dispute resolution. Dispute resolution covers you in the event of a lawsuit where your general liability or your malpractice insurance is not going to cover you in a lawsuit. And that's happening more and more where I'm just simply being sued. It had nothing to do with a medical practice. I might have a dispute with my partner. I might have a dispute with the people I rent my building from, or, all sorts of other things that go into that. So it's not going to be covered out of those scenarios. And then when you talk about cyber with HIPAA regulations and rules today, if you get fined today, insurance carriers aren't going to cover you for that. And if an employee makes a mistake, I can tell you situations where I had an employee for a dental practice put on Facebook that she worked on and she was a dental hygienist, and she worked on her first HIV patient. She just put that on Facebook, and she thought it was private in her private messaging, and it got out. And, those were really innocent mistakes. Kind of shockingly that, I'm sure she just thought that's not a big deal to say. Well, it is a big deal to say. That's a direct violation of HIPAA. And so now you got to unwind a lot of things. And so, there's these things out there that you're retaining all this risk on, and we call those unfunded liabilities. I fund a liability when I buy a traditional insurance policy on my building for fire. I've transferred that risk. I paid a premium. I've received a policy for that. And then there's a ton of risk that you're just going to retain. Now, how do you manage that more effectively? It was no different than the farmers back in 1986 that were retaining their own crop insurance liability, right? So we look at it much better. I mean, all of us grow crops every year, and that gets back to me being a farm kid. We start January 1, we all start regrowing our crops. That's, if you're any kind of cash basis company, you got to regrow. You got to plant the crop and you got to harvest the crop in a 365-day calendar. And how do you protect that crop more effectively, efficiently is utilizing a thing like an 831B.
Okay, so most of these captive insurance companies are now insuring risks that people were self-insuring anyway. That's what you're saying.
Absolutely.
You're not selling them some other insurance plan. They're putting money into this 831B plan and self-insuring something they weren't insuring before.
Exactly. They were funding it. They were funding it on their cash, on their cash flow. It's why PPP came out. It's why ERC and all the other things that we've seen in the last couple of years due to COVID. The government knew the insurance carriers weren't going to cover business interruption because why? It was indirect loss. Hey, we're telling you you're not essential, shut down. Well, my building didn't catch on fire, so that's not going to trigger business interruption. If you don't have a direct loss on your property, there is no business interruption coverage. Everybody gets business interruption coverage on their traditional policies. It's called the business operating policy, a BOP. But if you don't have a direct loss on your property, it doesn't trigger. So COVID is a great example of that where, hey, you're just shutting down. Well, they knew they had to come out with a PPP plan. They had to come out with ERC and all the other fun things that they did to make up $6 trillion of make-believe money. And one of the things we're driving home, and I appreciate being on your kind of your platform is, and talking with Congress, and I would encourage anybody that has an ear of any of their congressional leaders is, this has got to be the next plan. Owning an 831B should be as common as owning a 401k for your business. In fact, I tell clients, without the 831B, the 401k is at risk because we can't expect our government to step in next time, in my opinion, and bail us out. If the insurance carriers aren't going to cover this, which if you looked at the first month, March of 2020, when they closed through the month of April, we collect on average in this country about $250 billion in commercial insurances on all lines across the board, between auto, work, all of it, right? In the first month of April, it would have been $475 billion of business interruption that the insurance industry would have had to come up with in order to pay that. Now, we know that they can't, that is not sustainable. And meanwhile, though, so traditional insurance carriers will never cover this stuff, and we can't expect the government to do it as well. I just don't think it's a good idea. I don't know if we still fully know the ramifications for what went on when the PPP and the ERC came out. But to me, it's just going to become a normal business practice. And that's just dealing stuff with COVID. And then we talk about the other stuff I just mentioned already. So between supply chain risks, brand protection, cyber stuff, all the other things that go into running a business today, it needs to become a normal business practice, truthfully.
But all you're saying is that a business owner ought to set money aside to pay for these risks if they occur.
Well, a business owner. Okay, so good. Thank you. So,
I mean, the plan allows you to set it aside in a tax-deferred way and invest the money. But what you're saying is people ought to put more money aside for all these risks that they don't have coverage for.
Well, let's be honest. I mean, a business owner's got he's got a ton of incentive to spend money. He has no incentives to save money. I mean, it's just the way the world works currently in our country. This is the only program I know where a client, the business owner, has an incentive to save. And hey, this thing's been abused, right? I mean, obviously, anything that has advantages to the taxpayer is going to be abused. And, it was never designed to do what it was doing. And really, when you look at, if you were to Google the 831B, the IRS has won some court cases recently. I say recently, probably in the last 4 to 5 years. And really it had to do with estate tax planning, had nothing to do with risk management. The people that were selling these plans were attorneys that just happened to be estate tax attorneys. They weren't risk managers. That's all I know. So what in my professional life for almost 30 years, that's all I've done is risk management and develop strategies for business owners, either through utilizing traditional insurances or doing this kind of a plan.
Okay, so the benefits are if a risk shows up, you've got some money now to pay for that risk. If the risk doesn't show up, you've got another retirement plan. So what happens at the end of your career? You shut down this business, you got this pool of money sitting in an 831. What happens to it at that point?
We either shut it down after 3 years when you stop funding new risk in it. So like if, so one of our biggest industries is the medical community, for a lot of reasons. But I would say that, the medical community, doctors especially, are constantly worried about what they don't know. And very astute kind of folks are like, yeah, I know this insurance policy doesn't cover me for everything. I know my employees do stupid things from time to time. So they've done these programs very well. And I would say they've adopted very well to this program. The biggest thing is if they sell their practice someday, we even do we call it transactional risk, where you're going to have to retain some of that risk yourself. You did a rep and warranties, you sold your practice, you've retained some of the costs, meaning that they're going to have to pay you over a period of time for your practice. All of those things have inherent risk in them, and we do specialized stuff for that. But eventually the thing gets shut down. And when it gets shut down, one of the advantages, it comes out as capital gains. We also allow our doctors to take dividends throughout the year.
So it all comes out at once. It all comes out in the year that
it doesn't have to. Really, there's some strategies. We work with their trusted advisors, their counsel, their attorneys, their financial advisors to come up with an exit strategy on the back end of this. We don't participate in it, but we certainly advise our clients on how to do that in a way that, giving them ideas and then they can execute on it. But yeah, typically it's done over 3 years. Is the way, you don't have to do it all at once. Also, throughout the years of having the plan, they've made it taken dividends. We do a solvency testing by year 3 and 5. And what I mean by that is if you're having certain risk and now we've got the surpluses have grown, the pools haven't been hit, you haven't had your own claims and all that, we'll do a solvency test. We may, by year 3 or 5, we may tell you, hey, if you want to keep funding at the rate you're funding, you're going to have to take a distribution. No different than the RMDs in a 401k, where at some point you reach an age, they're going to force you to start taking money out of there. We do the same thing on this plan as well, but we do it through a solvency test that this basically says, hey, based on the risk you have, this is funded properly. If you want to fund again for next year, you're going to take a distribution now, and that comes out as a 1099-D, and it's a long-term dividend rates, which is taxed as the same rate as the capital gains.
That's pretty awesome, right? You take money out of a 401k, you're paying ordinary income tax. What you're telling me is when you eventually take money out of this plan that you didn't use to pay for risk, you're taking it out at capital gains rates.
Yep.
That's pretty sweet. So that's the benefit. Hopefully you don't use all the money you put in there and some of it can go toward your retirement.
I couldn't agree more. And in fact, I tell clients all the time, I said, you don't buy a homeowner's insurance policy with intent of using it. I can't think of any good scenario when insurance is being used. And so I'm with you. And now I will tell you this. One of the rules of one of our tests, one of the things you have to have in this product in order to elect an 831B, there's a 4-part test. The first one, there's a transfer of risk, which is no different than what I talked about earlier. You're writing a premium, you're transferring that risk to an insurance carrier. That has to be seen and designed. And again, as admin, we do that. Then you have to have a risk distribution. And what we mean by that is you can't own 100% of your own risk and call yourself an insurance company. And by its very nature, how are you utilizing the law of large numbers? That's one of the things the IRS is going to ask you. Well, you have to have this distribution of risk. And what we do is we call them risk co-ops. So if your company has brand protection and you're worried about that, and you're going to set aside a premium dollars for that, portion of those premium dollars will be put into the pool. I mean, all the money goes to you and everything else, but portion of those dollars are exposed to the pool. Now, the nice thing with our pools, we average between 400 to 700 operating companies within our pools. So we have claims almost every week, and then it's a variety of different claims. And I should also note, your company is only going to participate in these risk pools that you have risk for from your business. And the best example I give on that is a thing called foodborne illness. Foodborne illness is specifically used for anybody that manufactures, sells, or distributes food. Restaurants, farmers, grocery stores, any of those guys. That's food. If I don't, most doctors, for example, don't participate in food. So they would never be involved in that kind of a claim. They wouldn't have their dollars set aside for foodborne illness because why? Their operating company doesn't have that exposure. But for brand protection, dispute, audit protection, cyber, and all those things, you could be in there with a restaurant. Because why? Because they have the same, those type of exposures are just no different than a family practice office, right? They both concerned about their brand protection. They're both worried about supply chain risk, all those other things. So you will share within those risks, but that's really where, if a business owner, Jim, was to ask me, what's my real risk of doing this? Is that you're going to have to pay claims that are unaffiliated to you. Now, our pools have gotten so big where when the pool claim does come through, you may only own 30 bips of 1% of that pool. So, and like I said, we settle claims out every quarter to our pools. And, typically we're settling anywhere from, 10 claims on a quarterly basis that actually got hit by the pools. There will be a lot of claims that are either going to be denied and or it won't hit the pools because it's a layered type risk. And again, we got videos on our website and all that stuff to get more educated on that. But I really want to make sure clients, especially when they get involved with this, is, hey, I don't care what you've heard from our competitors, but you are going to participate in risk that's not yours. And if you don't have a claim, that doesn't mean your 831B plan is still not going to pay out in claims. It's just, how do we manage that more effectively and efficiently to where it's a calculated risk to do our program. And I think it's a risk we're taking.
Now they say you should avoid a bogus risk pool.
Yes.
What are they talking about when they say a bogus risk pool? What's that?
It's like attorneys selling risk when they don't know about risk. I mean, those things they got really cute. They were selling terrorism coverage. However, if you were in a vicinity of a million people or more, it was excluded from coverage. And so if I had jewelry stores in Phoenix and I'm worried about terrorism, but my terrorism is specifically excluded from me from having anybody more than 1 million citizens living within a 5-10 mile radius, which I think Phoenix is now the 4th or 5th largest populated city in our country, there's no coverage. So why did you put $500,000 away for terrorism when you knew it wasn't going to cover it? That's the bogus pools. Okay. We don't, again, they're just trying to make it look cute. They're trying to make it look like it is a distribution of risk when there really isn't. And so, unfortunately, those are things that we would call those bad actors in our industry. Unfortunately, they're still out there. They want to sell the sizzle. They don't want to tell the backside of the story on these that, hey, yeah, there's some risk to these things. They're not a risk-free venture. Nothing is. And by the way, if it's risk-free, it's like saying it's tax-free. And I always tell people, if you think it's tax-free, then you must plan on living forever because you're avoiding one of the golden rules, right? And so death and taxes. And so we don't go down those roads. And we certainly pride ourselves on our ability to say that you're in a pooled risk. However, we manage over 700 of these plans. And in those pools, we have large amounts of pools. And by its very nature, this is insurance. Why? Because we're creating a distribution of risk. We're creating the law of large numbers. Any one of our clients are going to have brand damage in 1 year, right? We may have a handful, but all that's going to be spread out between the other 500. When you look at 100 years ago, farmers, State Farm, anybody with farm in it were co-ops. It's just a couple farmers a great example is Farmers Insurance down in Orange County, Southern California. A couple of farmers got together because they couldn't buy farm liability for their vehicles. So they said, hey, we'll share You share with my risk, I'll share with yours. And literally out of that grew Farmers Insurance. You look at Allstate Insurance. Allstate Insurance was Sears and Roebuck's warranty company that sold warranties on their washing machines. And that's how that company grew up. And so today we're looking at all these different risk profiles that are out there that traditional insurance carriers will never cover, have no appetite to cover it. And now we're just forming these co-ops with like-minded people. And we're making sure as the admin that these meet the distribution rules. And again, I hope this doesn't sound like a rocket ship. It is, and I think you said it very plainly. It incentivizes business owners to put away dollars on a tax-deferred basis. They handle risk that they can't. They're taking it on by themselves. And I should mention, all they would do is pull. If any of these things were to happen, all they would do is simply pull money out of cash flow. Well, that's not a great business plan. Pulling cash flow out of a business on an unexpected expense can be very dangerous going forward as a business owner. Cash flow is the blood of the body, and you got to make sure there's plenty of cash flow to feed the body. And as soon as you start using it for other unplanned expenses, you're putting the business at risk. It's that simple.
All right, so let's go back to an example. A 5-doctor practice, they decide, maybe we're not going to form a captive for malpractice. We're going to do it for some of our business risk. We've got some cyber risk and stuff like that. How much money in premium is that business putting into the 831B plan?
So we adopted the crop insurance underwriting. Go figure. One of the things we do there is we look at their gross revenues and we cap them at 10% of their gross revenues. So even though you can put 2.6 million in these things, Congress allows you to do that. We go back in and say, listen, what's your gross revenues? No more than 10% of that. So let's say this doctor practice is doing, for simple math, $10 million on a gross revenue basis. And by the way, when you renew your general liability and all those other things, that's the first thing they're asking you is, what is your gross revenue? And the idea is the more your gross revenue is, the more likely for exposure for lawsuits or claims. So you're going to pay more premium because you're just making more money, or grossing more money, I should say. They don't really care if you're profitable or not. That's what we're going to do the same. But here's the difference. We're going to cap you at 10% and no more than 2% per risk. So if you want a max fund, we got to find at least 5 risks that you're self-insuring for that is related to you specifically. And that's really where we get this, and by the way, that's the ceiling. So the most is for this doctor group could do is $1 million. But out of that, we got at least five different risk co-ops they're going to participate in, because we're going to cap them at 2% on that stuff.
Okay.
So
but I mean, if we're talking about, cyber risk, right?
Yeah.
I mean, you can go buy a policy. It's not $200,000 a year for a business that size.
I couldn't agree more.
So how can you possibly justify putting $200,000 in there for that when you could buy it from another insurance company for $3,000?
We want you to buy it from an insurance company, but they're going to do a credit watch for the clients. They're going to do maybe some legal bills, maybe some forensic auditing. So if you got compromised, they're going to have to have a forensic team to come in and find out why you didn't. But there'll be a sublimit for brand protection, which is typically 5% of the limit, which would give you maybe $50,000 if you had $1 million policy. And then there's going to be a ton of exclusions in there. And that's really is our job, to read your policies and find the exclusions and fit in. And absolutely, you're going to overfund these things in the beginning. And I would say under cyber, we want you to buy your own insurance policy. Today, you can maybe buy one through Beasley, and it will cover you for your patients. It's not going to cover you for HIPAA violations. It's not going to. So there's going to be a ton of exclusions in there, Jim, and that's just one policy. And I'm with you on
raising the premium because now you're essentially creating a policy that doesn't have those exclusions.
Yeah, and if the private sector insurance companies aren't going to cover you for that, what you as an individual, what's the limit need to be? What's the premium? What should be the premium? And by the way, so then you add in dispute, you add in business interruption in general, which would cover you for indirect losses now, because you don't have, if you do have a direct loss, you're going to have an insurance policy for your office too, right? For your slip and fall coverages. And if there's fire in the building and I can't do my procedures anymore, I'm going to have business interruption on that. But if they shut me down because I'm deemed to be non-essential anymore, and I guess got to shut down because the government doesn't want exposure to a virus, I'm on my own again. Now, when I look at that, what the government did there for you, they provided hundreds of thousands of dollars for business owners to own. So again, it gets back down to the premium coverage. What's enough premium charges here? If I own a business and my payroll was $200,000, I got 4 times that on PPP. So the complexities of the premium is definitely, and here's the thing, I'm not here to replace traditional insurance. I say go buy as much as you can, as much as you can afford. But understand that traditional insurance carriers are going to keep adding more and more exclusions. Your insurance policy doesn't get thicker because they're adding more coverages. They're getting thicker because they're adding more exclusions. And then you add on top of that all the things that you're self-insuring for, right? Look at the prescriptions. Look what's going on today. I think November 1st, you cannot prescribe certain peptides anymore. Starting November 1st. Done. Now, if you tied a bunch of your patients to selling peptides for weight loss, human growth, and all the other things that's been going on out here, that's actually making people healthier, in my opinion, FDA just said today you can't prescribe that anymore. Now, what happened to all your revenue? What happened to that supply chain risk? No insurance company is going to cover you for that. But meanwhile, you've hired more PAs, you've hired more practitioners, to do all this for your patients. And now you can't even prescribe the drugs that you were actually helping patients with. And it's a temporary suspension on the peptides. What does that mean? 6 months, 2 months, 3 months? Am I supposed to hang out with all my employees because I built my practice around using alternative medicine, through functional medicine type stuff? Those were unexpected, and we would call those political risk. Medical practices are a huge, huge exposure to political risk. They're required to have license.
So basically, you can now fund an insurance company, your captive insurance company, to insure against that risk.
Absolutely.
Okay, so the obvious incentive here, because you're turning ordinary income into capital gains and providing a period of time when the money can grow in a tax-protected way, the incentive is to have the premiums as high as you can get them, assuming you have enough cash flow to run the company and pay your salary.
Well, and now you can see why
obviously, if you set them ridiculously high, the IRS or some sort of regulatory agency is going to come in and say, no, that's illegal. This is tax fraud. You're going to jail. So how do you make sure the premium?
Well, let's back up on the tax fraud. No, that's tax fraud is tax evasion. This thing's a tax avoidance. There is a little bit, I would say there's a substantial difference. These things only get done in civil cases. It doesn't rise to the level of criminality. So nobody goes to jail by doing this program, first and foremost, not unless you did something fraudulent, which, me interpreting a tax code to my benefit doesn't mean I did something fraudulent. And so overfunding, and it brings back to what I was saying earlier. That's why we run a solvency test. We will force distributions. You don't get to keep putting money in these things, because to me, it does start to look like a tax shelter. If I'm not having my own claims, or I'm not turning my claims in, and the pools aren't being hit as much as they are, absolutely, you're overfunding the risk. In the beginning of these things, you start out zero capital, and you're insuring risk for the first time for your business. And I would get back to the conversation, what's the appropriate premium for that? We gone back and adopted it under the crop insurance program and said, here's what the crop insurance program does. So we're going to cap, if my crop's worth $100,000 of gross revenue, I can insure for that. Well, I got to put up 10% of the value of the crop to do that. The government, though, matches me on the backside of that. So they're actually putting up $20,000 for $100,000 policy coverage. So that's how we came to our methodology, underlying the premiums. But I'm with you. After a certain period of time, you just don't get to keep piling more money into these things. We will force a distribution, and unfortunately, clients do have claims. And when those claims come out, they're going to be a substantial dollar amount coming back to your operating company to keep it solvent.
Okay, so the distributions, those come out at ordinary income tax rates?
Well, assuming the premium's been in there 1 year, 1 day, It would be considered long-term dividends, no
Long term.
capital gains.
Cool. All right. So the money's sitting in there. What is the money doing while it's sitting in the 831B plan?
So we don't our clients sign an investment agreement with us on this, what they can and can't do with it. And there's two different buckets of money I want you to be aware of. One is reserve and one is surplus. The reserve is premium at money, the premium you put into it is at risk for that. And typically there's a 12-month policies are at risk during those 12 months. Like when you write an insurance policy for your malpractice or for your business or whatever, it's a 12-month policy. That's how commercial insurance works. You might get some tail coverages for your professional liability insurance for 35 years, but that's a different animal. But typically they're a 12-month policy. So that's what's going to happen. The premium during that time that's a reserve, and that money's at risk for claims of either yours or unaffiliated to you. Now the policies expire, meaning they go out of force. That premium now, assuming it hasn't been paid out through claims, is become surplus. It's called underwriting profit for insurance companies. It's truly what they live and breathe to have. I always get a kick out of, we're losing money this year. Well, that just means you don't have any money to put away. And then they act like they're going broke when they actually have to dip into the surplus because they had a catastrophic event and now they got to pay for hurricane losses they weren't expecting. That's surplus. But understand these are monies that have been piled up. Billions of dollars have been piled up into I would tell you, traditional insurance companies are some of the strongest financial institutions we have in our country. It's their ability, it's the way they're taxed and everything else, and in the surplus that goes into them. So our clients get the same advantages. That money becomes surplus. Obviously, it's eligible for a dividend because it's 1 year, 1 day. They leave it in the vehicle. It's being managed. We work with financial advisors all over the country to manage these reserves. We don't put our hands in that, and we just tell the client, here's the rules of engagement. Here's what you can and can't do. The reserves need to stay liquid. And to us, liquid is managing it in the bond stocks, bonds, mutual funds, and all that fun stuff. Once it becomes surplus, there can be some more additional investment strategies put in there, and we're advising our client on that, but we're not participating in that, if that makes sense. We're not managing those reserves or surpluses. We're letting their trusted advisors do that for them, and we just tell them the rules of engagement, how it needs to operate.
Okay, so let's say they want to be their own trusted advisor. Is this at a brokerage account at Schwab? Where's the money sitting?
We require all of our clients to open up a bank account.
Uh-huh.
And that's really for us to move money into that easily, and also debit the account when there's claims that need to be paid on a quarterly basis. Okay. So meaning if they didn't have their own claims, they get an email from us saying, hey, we had 4 claims settle. You're participating in these co-ops. It's $450. That's how much money we're going to take out of your account November 2nd. So we always require a bank account. Obviously, banks are paying pretty well right now. So, they can, and we have a lot of clients that's sitting in cash right now, truthfully, in a money market account or wherever. And then we have clients that have financial advisors. They open up an investment account on Pershing, Schwab, whoever, and trade the account too as well.
All right. So stocks, bonds, mutual funds, cash, CDs. What
we don't want is non-traded securities. I would say non-traded REITs is a big one for us. Not with the reserves. That money's got to stay liquid, and that's really I would say that's the big rule for us.
Liquid. You can take quite a bit of risk with liquid.
You can
securities. I mean, what you're telling me. I mean, someone could essentially put it all in the stock market.
Well, you can, but there's rules based on our investment agreement the client signed. There's rules and regulations on that as well. Okay. And
they got to keep a certain amount in cash or bonds, or how's it work?
Yeah, it's got to be a balance. Like I think one of the big rules is you can't have more than 10% of your overall portfolio in any one stock or bond. So designed to limit your exposure if you want to, and no Bitcoin. We get that asked all the time. There is no Bitcoin that you can invest in. So we'll put restrictions in the investment agreement all the time. And Bitcoin, I would say in the last handful of years, we've had to introduce that because, some people tell me it's liquid. I don't know enough about it to even talk anything at any level of education on that. But we've just made a decision that no, you can't invest in Bitcoin. So
But someone could put it all in an S&P 500 index fund, something like that.
as long as it's not more than 10%. So even in that situation, no more than 10% in the S&P 500.
Even though there's 500 stocks in it, that would be
Yeah,
considered one investment.
I know.
Okay. So they got to be 10 different investments, basically.
Yeah. Yeah.
But they could be a 500 index fund from 10 different providers.
See, I get questions like, see, you're a creative guy.
I'm just curious how it works.
No.
Insurance companies hold, right? If you look at the assets of a big insurance company, it's going to be mostly cash and bonds. And I was just curious if there's some rule with these captives that it's got to be fairly low risk investments. What I'm hearing from you is that's not necessarily the case.
No, it's not. Absolutely not. I mean, especially if it's surplus. I mean, the surplus is the surplus. I would tell you that, a lot of insurance companies have loans. A lot of insurance companies do loans. I mean, if you look at their overall portfolio right now, I would tell you that it's probably 30-40% sitting in loans. There's been some stress on that, they're sitting in these low interest rate, some of these loans haven't reset yet. And meanwhile, interest rates right now, they get 8-9% on a corporate A-rated bond right now, right? So that's been interesting talking to some folks. I mean, we work with a lot of major insurance carriers as well. I mean, one of the ones we obviously work with is out of Lloyd's of London, and because there are times when we do replace traditional insurances. I have a whole nother arm in my company that, if you're paying north of $400,000 in traditional insurance between work comp, GL, property, commercial auto, we could start to look at taking over your traditional insurances if you have risk, meaning if you're willing to take on more risk yourself. And all that is you're taking on a bigger first dollar risk, meaning a very large deductible. And if you have the risk for it, we do those as well. But it's a case by case and it's underwritten in a way. But those are called macro captives, and we deal with that a lot. I would say a lot of construction companies, hospitals do it. A lot of hospitals are doing that with their buildings, and then also their malpractice and everything that they own. They like to own captives in Hawaii. I think Hawaii requires the presidents and directors to have their board meetings in Hawaii. So that's another reason why Bermuda, Cayman. When you look at companies like UPS and other companies that are large like that, they all own all these things offshore. They're trying to do it for a lot of reasons. There's now 35 states encouraging you to own these things within their states. And they're doing it for premium taxes, for domicile fees, for taxes, and everything else. So, again, we're heading in a place where this is becoming a normal business practice. And really, it's an educational thing. I mean, even though this thing's been on the books for 40 years, the biggest people to adopt it were Fortune 500 companies, warranties. Auto dealers, the reason why the F&I guy pushes you so hard for their service contracts is because they're retaining all that risk themselves for your warranty. They're just utilizing an 831B. And I can tell you about that business model. I think it's a beautiful business model, what they do with those reserves. They turn around and increase it on their flooring, or they put it in their consumer investment arm for loaning out vehicles because the people have too high, they don't have great credit. Banks aren't going to loan money to them. Well, they can use that money to still sell that car to them and get 24-28% interest on that money. Great business model.
All right. So we've been going for a while here. I wanted to spend at least a little bit of time, though, talking about not getting in trouble, right?
Yeah.
I mean, there are people out there selling these captives as a tax mitigation tool, not a bona fide risk reduction tool. So how can a doctor looking at one of these for their practice know that they're not getting involved in a scam? They're not going to end up having some terrible audit experience for it, that they're actually, running a legitimate captive?
Yeah, I would say that, really what's the background of the manager? If the background of the manager is preparing taxes or doing tax returns, or it's an attorney doing it because they're a tax attorney, then you might want to question, because their motivation is taxes. I mean, I don't know how to make it plainer and simpler than that. And I think also be well versed in a 4-part test. Is there a transfer of risk? Is there risk distribution? What should be my expectations in sharing other people's claims? then there's a thing called a fortuitous risk, which means it has to be insurable type risk. It cannot be planned and it cannot be expected. That's not insurance. And unfortunately, I see a lot of business owners get wrapped up into certain things that I would think is more business related risk than it is a insurable type risk known as fortuitous. And then the fourth one is are you acting on the principles of insurance? Are there reserves? Are there solvency testing? Is there financials being prepared for me? Is the policies being issued in a timely manner? And are the policies backed? Are they policies that I actually will have coverage for? What is the claims process? Is there a defined claims process? One of the things that puts us unique position as an admin, we're not going to cover claims that aren't legitimately covered under the policy. We have to hire an independent third-party adjuster to adjudicate these. We have to at times get legal opinions based on the wording and the scenario that came in under a claim scenario. Is this covered or not? That all has to be defined because why? We have a distribution of risk. Our clients aren't going to want us to cover claims willy-nilly. Why? Because they got to participate in that claim. So those are, I would say, probably the biggest thing is, what is your claims process? How is it defined? And what is the distribution of risk? Because when people have gotten in trouble with these things, it's when they made it look like there was a distribution of risk when there really wasn't. And that's, I hope with our discussion, you can see that we are a differentiator in that space. We absolutely have those, and you will participate in that if you're going to be a client at SRA. That's the biggest thing for me. And then two, who's your risk manager? Who's your team that's assessing the risk? What's their qualifications? And the other thing too is if you're paying for a feasibility study and an actuarial and all this other stuff, and they want to charge you $30 or $40 or $50,000 for that, that's ridiculous. These things are not complicated. If you've been in business for long enough, we know your industry, we know what exposures you have. You shouldn't be paying that kind of money for that stuff. And to get all that, it's just, when I first got back in this in 2008, I saw fees that were being charged that just were ridiculous. And I can't tell you how many times I met with business owners that said, well, I looked at these things, they're too expensive. It doesn't make any sense for me. And I say, yeah, I agree. One of the things that we pride ourselves on to start this program is $6,000, and to maintain this program is $6,000. And that's all done through the 831B plan. So if your investment advisor is getting you more than $6,000 on your investments, this is going to cost you a frictional cost. If 1 year you decide, hey, I can't pay a premium, guys. The economy took a hit, and I'm not making the kind of money I was making, and I can't afford this. What I saw back in 2008, 2009, 2010, that they were still paying $40,000, $60,000, and they weren't putting any money in these things. I just thought it was egregious. And so I'm trying to help the small to middle market business owner. This was the code the code was written for that group. Unfortunately, the big adoption people have been the big companies, and they love this program, right? And is the IRS going to go challenge Microsoft? I don't know. On their tax returns, I don't know. I look at Deloitte. Deloitte has, last time I heard, Deloitte has 240,000 employees. I think the IRS has like 82,000. If Deloitte's preparing your tax returns, there's probably a good chance that, maybe Deloitte's telling the IRS what's going on. But anyway, so those are things that I kind of bring into place here that, I would tell business owners all the time. And, when a business owner comes to me that has these plans, that's the first thing I ask him. Well, what's your claims? What claims have you paid that are not your own? Well, I don't know. I've been in this for 5 years, and I don't even know what you're talking about. Then I'm like, oh, okay. Well, what were you doing? What and then we dive into it. And of course we get their insurance policies and all that kind of stuff. So, it's not it's a legitimate code. Congress, both sides of the aisle are a believer in this code. They believe its ability for small business to manage their risk more effectively and efficiently. And we just got to get, some of the bad actors out. I mean, they're there. There's not as many as there used to be. I think there's better rules and regulations coming out through case precedents that kind of make the business owners a little bit more savvy, their advisors a little bit more savvy on some of the things they need to be looking out for. And one of the big one is demonstrate to me how the distribution of risk works. That's the first thing I would ask anybody looking at one of these things.
Very helpful. Well, Van, our time is long gone, but it's been an interesting discussion. I haven't, had a long discussion about this subject before, so I hope the podcast listeners find it as interesting as I did. If they have additional questions for you, what's the best way to reach you?
Really, 831b.com. We got educational videos on there. They can reach out to my team. We probably have about 150 advisors around the country that represents our products that we'd love to hook you up with if you happen to be in those areas. And it's an educational process. And here's the thing, Jim, it's a tool in a toolbox. For the right client, it's a great tool, but it's not a silver bullet and it's not a tax-free venture. It's none of that stuff. It's risk management that has some tax strategies to it. That's it.
All right. Very helpful. Well, thank you so much for coming on the podcast.
Thank you. Appreciate it.
All right. I hope you enjoyed that interview as much as I did. Obviously, it's longer than most of our episodes, but I hope it was worthwhile to you. Those of you who are in business for yourselves that would consider a captive insurance. It got me thinking. I'm like, wow, what could I do with White Coat Investor or with my partnership with captive insurance? Because that's a pretty serious tax break. Not only do you get to have that money growing in a tax deferred way or tax protected way for a long time, when it comes out as at qualified dividend rates. Right? That's not quite as good as HSA treatment, but it's better than 401k and Roth IRA treatment. It's pretty awesome. So something to think about there anyway. All right. Our sponsor for this episode is Comp Health. Locum tenens is a smart way to pay down student loan debt or make extra income. It also gives you freedom and flexibility for better work-life balance. Comp Health is a leader in the locums industry, and they help you navigate all the options to meet your needs. They have access to thousands of jobs, including telehealth, medical missions, and even permanent placement. They even coach you for interviews, help you refine your CV, and negotiate your contract. Comp Health recruiters are partners because they place your best interests at the heart of everything they do. Learn more at comphealth.com or visit them in person at WCI Con 24, February 5th through 8th in Orlando, Florida. Don't forget about our contract review recommended list. You can find all our recommended lists at whitecoatinvestor.com/recommended. Thanks to those of you leaving us 5-star reviews. We have a recent one left by Lay, who said, always inspiring. This is such a great podcast and an inspiration to medical professionals to take control of their own finances. 5 stars. Thank you for that. Help spread the word, getting this information out into the hands of those who most need it. All right, so that's it. This episode's been long enough. We've had a long day. We've been at it for about 9 hours today recording. We're ready to be done. So I hope you're ready to be done listening. Keep your head up and shoulders back. We'll see you next time on the White Coat Investor Podcast.
The hosts of the White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.